Alright, so I'm Jeff here back again with another video. So today we're going to be talking about what the Federal Reserve is going to be doing on the 16th of March potentially, and also what they have actually been doing on Monday, which was during the closed door Federal Reserve emergency meeting. All right, so first of all, we actually have to talk about Bullard coming to CNBC talking about the credibility is on the line, needing to front load rate hikes. So first of all, he actually talked about a little bit on, I do think that we need to front load more of our planned removal of accommodation than we would have previously. So over in this line alone, it basically just means that in order for the Federal Reserve to actually combat inflation to a certain extent, they would have to end the taper a lot sooner than we expected, aka a more aggressive taper. So what a more aggressive taper would also entail, it means that 2 days ago, during the Monday's closed door emergency Feds meeting, we're expecting that the taper would have already ended. Of course, this is not public information, nor is this accurate information as of now. We might be able to know it if Jerome Powell actually choose to disclose this to us on the 16th of March. But of course, there are no promises on that front. So yeah, I don't think those minutes are going to be disclosed either. So because of that, we do not know when the taper is going to be ending, but we are almost 100% confirmed that we are going to be getting the rate hike on the 16th of March. Right now, the only question is, are we going to be getting a 50 basis point, aka 0.5% increase, or a 25 basis point, which is a 0.25% increase? All right, so over here, we've been surprised to the upside on inflation. This is a lot of inflation. Our credibility is on the line here, and we do have to react to the data. However, I do think that we can do it in a way that's organized and not disruptive to the market. So, of course, personally, we do not want this entire change in interest rates, all these rate hikes to be disruptive to the market. But the market is basically a living thing, and the market knows how to react to new news and such. And when the market see 50 basis point increment, if there were to be a 50 basis point increment, the market is going to freak out. And I think that's very, very normal for the market to do so. But the reason is, I actually received an Instagram question yesterday, and I was talking about it. I was replying to it, and I thought that it was actually quite interesting. And if you're not following me on Instagram, right here, okay, follow me at @onghauser. Actually, I upload on my story every single day, and of course I do some Q&A from time to time. So if you're interested in some question, just feel free to drop by. But anyway, the question was basically asking me if we were to hit a 1.25% interest rates by 2022, why would it even matter, and why would it help with inflation? So I actually brought up this sort of a dilemma that we have in the market at the moment. So if we actually raise our rates very, very aggressively, like how Bullard probably wants us to do so, which is getting to 100 basis point by July in 2022, aka 1% by July. Of course, there's going to be really front loading all the rate hikes, trying to bring us to a very, very high interest rates in a very, very short time. But the thing is that in return, will basically be getting a short-term recession, which is the biggest concern that everyone is having, because in terms of a short-term recession, we do not know what's going to be short-term. Okay, it's not up to us. It's not up to us to call it short-term. We might think that it's going to be a month. We might think it's going to be 3 months. But how a recession works is that statistically, a recession has usually lasted almost to a year. So we cannot really call it a short-term recession if it were to come. The second thing is, if we do not raise rates at all, which I think there is also a whole nother group of doves out there who think that the Federal Reserve should just keep the cheap money that we have in the economy. When the economy basically keeps on churning out money, the money will eventually flow back in the economy. We do not have to increase the rate so strongly. I do not think that should be the case either, because if you actually do that, it's almost saying that economies in general has not been going up when we have slightly higher interest rates, aka your 1%, your 2%, or even your 3% interest rates. You're saying that economy do not flourish at reasonable interest rates, which I think is a complete false thinking, because usually for all these sort of interest rates, we are expecting them to hit about 2%, and we'll still have a good economy. Right now, going to 1.25% is not going to be destroying the economy. However, if we do not raise rates at all, aka if we're going to just leave it at 0%, the fear is that we are going to be getting hyperinflation. Okay, in this hyperinflationary environment, there's also different situation that you'll be afraid of, which would be which price spiral. So, for example, if all the employee in the world right now, if the consumer price in general just go up, so be it your fuel costs, the car costs, your electric costs, energy costs, food costs, clothing costs, apparel, whatever it is, everything just keeps on going up. We see 8%, 9%, 20%, whatever it is, it keeps on going up, piling up. The people who are working and getting, let's say, $5,000 a month, $100,000 a year, whatever it is, those people will probably have to start thinking, oh, hold on, I would need to make more money for me to actually afford all these sort of consumer centric items. And because of that, they kind of go to the employer, all right, boss, can you please give me a raise? Okay, inflation is hitting so hard, we need a raise, otherwise we are not able to afford all the things that we need to afford to continue living, and that sort of thing. And because of that, the employer would have to basically raise their wages, because if they don't, then basically you're gonna have the whole Great Resignation, which is what basically happened at the end of 2021, basically, because prices keeps on going up, and then when employee basically just ask the employers, okay, do you want to do a 10% increase for me? Because if you do not want to do a 10% increase for me, I'm not going to be staying here. I'm going to go to your competitor, and if I go to the competitor, they are probably going to give me 20% anyway. So do you want that to happen or not? And then they probably just be like, yeah, I cannot pay you 10%. They leave, they go to another company. Of course, the next company would also have the same thing happening, and this whole thing just kind of spiral down, which is why they call it the wage price spiral. Okay, and of course, this will means that companies lose employees, and also employees are the ones that are gonna be saying that, at the end of the day, I don't want to get a job. Okay, you know what, like I can do my side hustles, I can do my YouTube channels, I can do trading, I can do crypto, I can do NFT, whatever it is. I don't have to I don't have to have a job, that sort of thing, which I think that it kind of works out to a certain extent, because I've been doing it myself as well. But of course, it would be very something that you have to be very, very cautious about, to say the least. But that's why I think that for which price spiral in general, when this actually happens, that means that when your consumer price goes up, people will ask for a raise. The companies do not want to give them a raise. They lose the employees. The employees go to another company. The other company do the same thing, and then just keep on spiraling now. And that's kind of the issue if we do not raise rates, because prices are just going to keep on going up. And of course, the companies are going to be doing quite all right, because if prices keeps on going up, if we get food prices continuously going up, okay, the foods and beverage industry are not going to be like, okay, you know what, we're not going to be increasing prices. We're going to be taking the blow for you guys, just so that you guys will continue being our patrons. I don't think that's how the F&B industry works. If anything, it will just be like, okay, yeah, keep on coming. Okay, there's going to be a 10% increase by the end of the month, or there's going to be a 15% increase by the end of the year. Whatever it is, that's what they're going to be doing continuously. And I think that that's a hyperinflated economy. Of course, I am not old enough for me to actually see some any form of hyperinflation, or even have any sort of hyperinflated environment actually affect me in real time. But yeah, I mean, because of that, I'm not super duper worried about it for the hyperinflation side of things. But okay, and the third scenario would be if they actually raise rates at a very, very steady pace, which aka 1.25% by 2022. The situation that we'll be having, no, yeah, it was 1. It was 3 times, so it was 0.75%. Yeah, it was 0.5%, which is 75 basis points, according to the December dot plot that we actually had from the FOMC meeting minutes. If we actually got that instead, we would face a possible scenario of a stagflation, and I think that would be also another set of problems. The last time we had a stagflation situation was, I think, back in 1970s, and because the rates are not going up fast enough, and the inflation is still going to continue piling up. And of course, right now, I do see some form of a peak at the inflationary data that we have been seeing on the CPI itself. I would not feel super assured at the moment as well. Of course, I do see some form of peaking at the CPI. I do not think that we will keep on getting horrible costs. I think especially with what Russia did with Ukraine, when they actually increased the prices of oil per barrel. The moment that when Russia basically partially withdrew their troops, oil prices, of course, went down in well, for obvious reasons, and because when oil prices goes down, we need the oil prices to stay down, and that's the issue. Because if oil prices continues to stay down, that's how we can actually regulate the prices of oil. Right now, I think the oil prices is about $90 per barrel according to the WTI, and because of that, we have to ensure that oil prices continues to go down slowly, and not just suddenly having a dip, a huge dip out of nowhere. So right now, that's what we are actually going for. Hopefully, we can kind of see the prices of oil go down, and because of that, consumer-centric items prices will also go down bit by bit. Of course, this is how we actually look at for the CPI data that's going to be coming out. But because we just got the CPI for January, which was, well, I won't call it terrible. I actually covered it as well. It was 7.5% inflation year over year, but I personally thought that it was actually quite all right. So we're going to be getting the next one. I think it should be on the 12th of March. We'll get the CPI, no, 10th of March. We'll get it before the FOMC meeting actually starts. So that's going to be good. We can actually somehow strategize what we can actually do before the FOMC meeting actually happens. But anyway, today we'll be getting the FOMC meeting minutes for the January FOMC, and I think that will be a very, very interesting one for us to actually look at, because the December minutes was horrible, and I think that the January one, we kind of want to see some of the tonality that's going to be happening in the entire transcript as well. We want to see how the Federal Reserve as a whole actually treat this entire situation, and how they're going to be combating inflation and also raising rates reasonably for the rest of the year and even the years after. But yeah, these are just my thoughts about what the Federal Reserve are possibly going to be doing in the next few weeks. So yeah, these are the things that you probably will want to know before the FOMC meeting that's going to be happening on the 16th of March, when Jerome Powell comes out to talk about everything that transpired in the meeting. But anyway, I thank you guys for watching, and I'll see you guys